So this is a cautionary tale. It's a story of a buyer and a seller, unrelated transactions, and how they both got very, very ripped off by stolen cash when they bought a business. What do I mean by that? How can that be? Stick with me. I'll explain it to you so you don't make the same mistake and that you don't get ripped off as well. So I've been a business broker for almost 20 years, and in my first few years of selling business, when I was just starting out, I came across both these characters. I won't give you their names, I'll protect the stupid, because, well, you got to do that, don't you? But in both cases, one was a seller, one was a buyer. There was lots of cash in the businesses, and they saw that as a way to, I guess, make extra money without declaring it to the tax department. I'll talk a bit more about that in a minute. Now, they made some fundamental errors and they got ripped off. Simple as that. Ripped off quite badly, actually. Now, I got these stories. I wasn't the broker involved, but I got these stories direct from both the buyer and the seller. So it's a cautionary tale, and here it is. So what am I talking about when I talk about stolen cash? Well, cashies, back pocket, under the table, undeclared earnings. So that's revenue, money that comes into the business that the business owner doesn't put through the books and doesn't declare to the tax department. Now, clearly the logic behind that is if he takes cash or she takes cash in the business, puts it in the back pocket, it's hidden, if you like. It doesn't really exist. You don't pay tax on it, and they can use that money to spend on other things as well and basically dodge the tax department. So when we're talking about stolen cash, when we're talking about cashies, undeclared earnings, it's all the same thing. It's undeclared earnings. Now, those earnings clearly don't appear on financial statements or go through the banks and things like that. So to all intents and purposes, undeclared earnings, they don't actually exist. Now, some business owners believe that this undeclared earnings, if you like, this stolen cash, whatever you want to call it, adds value to their business. And I often get commented, oh, hey, well, that's great, but it's worth more because of the cash I take. Now, is that true? So let's just pause a minute and think about, how do we value a business? Well, we value the business based on the profit it's generating. It's a pretty old formula. You take the profit, you multiply it by a multiple based on sales of other things, and that's how you arrive at the value of a business. So if you're taking cash out of the business, you're effectively reducing the value of the business. Now, we can't take that cash into account when we're looking to value the business, when we're looking to decide what the profit is, because if it's not in the books, it simply doesn't exist. If cash is coming across the counter and going into your back pocket, how do we prove it to a buyer? How do we show a buyer that it's there? Well, the normal way of showing a buyer revenue is through bank statements, through invoices, and through till recognition, if you like, or point of sale recognition. So if that money doesn't sit in those items, how do you prove it's there? So the short answer is, taking cash out of a business doesn't increase the value of the business because you simply can't prove that it's there. But why would you do it anyway? Let's take a very simple example. So we've already said that businesses are valued on the profit that they generate. So let's take a simple formula. Let's say that your business is worth 2 times profit. Now, that's fine. Most businesses we sell are worth more than that, but that's the base level. We'll say 2 times profit. So for every dollar that you don't put into the business, you're saving tax. Now, the current tax rate in New Zealand is 28 cents. So you're taking $1 out of your business and you're saving 28 cents. But at sale time, that dollar of profit that's in your business turns into $2 on the sale price. So for every dollar that you take to save 28 cents, it's costing you $2. Now, that doesn't make good sense to me. If I said to you, every time you give me 28 cents, I'll give you $2, wouldn't you take that? Of course you would. Simple formula. So why do you take the money out in the first place when you're going to sell your business? Just doesn't make any sense. Leave that dollar in, let it to turn into $2 at sale time. Now, a buyer's going to look at you and look at your business, and he's going to go, well, if you're lying to and stealing from the taxman, what's to stop you lying to and stealing from me, the buyer? How can I trust what you say if you're admitting to the fact that you're a dishonest person? So that's the buyer's point of view. Now, the banks take a similar sort of view. they're going to lend money to the buyer based on what your accounts are doing, what the business is doing. That's how a buyer funds it. Now, a buyer can't go to the bank and go, oh, there's lots of undeclared earnings here, lots of cashies. Bank doesn't care. Bank is going to look at what's on the accounts, what's on your GST returns, what's on your bank statements, and what your invoices say. So to help that buyer fund the purchase of the business, they need good set of accounts to do that. And those good set of accounts support the asking price. Again, cashies don't add value to the business. But let me get to the story of the buyer and the seller and how they looked at cashies in a business they were looking at. So we've already said that undeclared earnings doesn't add value to the business. Remember, you can only steal the money once. But what happens at sale time? Well, this is the story of a buyer. Now, a buyer, he went to buy a business. He had a look at the business, looked at the accounts. The accounts were okay, but it wasn't making a lot of money. Now, the seller said to him, well, don't worry about that. Lots of cash in the business. In fact, I take a whole lot more cash than what I'm declaring. So the business is way more profitable. Now, I can prove that to you. So the buyer said, well, how much are you taking? It was a lot of money. So he said, well, prove it to me. How can you prove it to me? So the seller said, why don't you do a turnover verification? So you can sit in my business for a week, 10 days, and you can watch as customers come into the business and they pay money, and you can see me take the cash, put it to one side. Use your calculator, add it up. We can add that on to the week or 10 days revenue based on the invoices and things like that. So you'll see the true picture of the business. How would that sound to you? Now, the purchaser thought that was a good idea. He's going to sit there, he's going to watch the cash come through the business, and he'll be satisfied that on an average week, this is what it looks like, this is what the cash looks like. But there was a problem with that. So the problem was simple. Remember, we're dealing with fundamentally a dishonest seller here. He's lying to the tax man, lying to the bank, pretty much lying to everybody about the revenue. So what he was doing was, I think this is great, what he was doing was he got friends, he got family, he got people he knew to come into the business, buy some big ticket items, pay with cash, and leave. Now the purchaser's sitting there, he's adding these things up and he's going, hey, this looks really good. Lots of people coming in, lots of cash in the business. But what he didn't know was, because they were friends and family of the seller, of the owner of the business, what was happening in the evening is they were bringing the goods back, getting their money back. So all that was happening was the poor old buyer was sitting there thinking that all this money's coming through the business, when in fact there wasn't any money coming through the business. It was just a total sham and a total lie. Poor old buyer, what's he doing? Well, he's under the illusion or delusion that there's a whole lot more money in the business than what there really is. So he goes ahead, he pays the extra money, he buys the business. A month later, 2 months later, he realizes his mistake. He's well overpaid for this business, and there is no cash. There is no undeclared income in it. What had happened was the seller had told him about all this undeclared income. Because you can't prove it, how do you look for it? How do you find it? You can't. You've got to take the word of the seller on trust. So there was undeclared income, certainly wasn't there, and he certainly didn't get the benefit of it. Poor old buyer. Okay, so the seller. Now, how did he get ripped off? Well, quite simply, what he did was he said to a buyer, he said, look, he said, this is my business, this is what it looks like, and these are the books that the accountant produces, here's the bank statements. But what I've got over here is another set of books. Now, this is the true picture of the business. Now, this includes all the cash I take, this includes all the expenses that I load and things like that. So what you're seeing here is the true picture of the business. Now, I don't show this to anybody. I certainly don't give it to the tax man, and this is the accounts I give to the bank and the tax man. So as you can see, the business is actually making, well, almost double the profit that I'm suggesting it's making through our usual accounts. Now, the buyer thought, hey, this is great, very profitable business. They agreed on a price that included the undeclared earnings, if you like, that included the inflated price, and he said to the buyer said to the owner, hey, I need to do a bit of a due diligence. I need to go through and confirm all that. He gave him a whole list of things that he asked for, went through, confirmed it. It all added up. Buyer was very happy, seller was very happy. Yes, that undeclared earnings was there, and I'm going to buy this business, says the buyer. Well, so far so good, nothing wrong with that. Everybody's happy, the undeclared earnings were there, buyer's going to buy the business, seller's going to sell the business. So what went wrong? Well, this is what happens when you're dealing with fundamentally dishonest people, and I keep saying it. This is great. I felt sorry for the seller actually, but anyway, so what the buyer actually said was, I'm going to buy your business, I'm not going to buy it at the price we've agreed, I'm not even going to buy it at the price that it should be without the undeclared earnings. I want a discount on that. So I want to pay half the price of the business and you're going to sell it to me. Now the seller looked at him and said, what do you mean I'm going to sell it to you? No, I'm not. Buyer said, yes, I am, and here's why. And this is when the buyer pulled what can only be described as the masterstroke of dodgy dealings. He looked at the seller and he said to the seller, you're going to sell me the business and you're going to sell it to me for the price that I've said I will pay. And if you don't, I'm going to take all your records and I'm going to dob you in, I'm going to ring the tax department and I'm going to say, here's a guy that hasn't been paying tax for years and you need to do an audit on him. Moreover, I'm going to put all this information together that you've given me to prove that that cash isn't being declared but is there, and I'm going to give it to the Inland Revenue Department and I'm going to say, there's the evidence, and away you go. So I got this story from the seller, so I do know it's true. So he ended up selling the business at a knockdown price, lost a lot of capital gains, in fact lost money on the price he sold it to. Why? Because he was stealing money. He was trying to dodge the tax man, and he was too scared that he would get prosecuted by the tax man for tax evasion or tax avoidance, whatever the terminology is. And because he'd owned the business for 7 or 8 years, he was really worried that they'd go backwards over those 7 or 8 years and really charge him interest on unpaid and fines and everything else. So it was far cheaper in his mind to sell the business at a knockdown price and get out of there. But that's the lesson. That's one of the pitfalls of cashies. Because you're dealing with fundamentally dishonest people, you can get bitten, and bitten hard, which is what happened to him. Okay, so you know not to buy a business with cash, or be very careful when you buy a business with cash. But what other business should you not buy? Well, have a look at that video up there. That'll tell you what other business you should not buy. There you go. I'll see you over there. Thanks for watching. Cheerio. I'll get out of this hot sun.